Secret ways to buy property without the bank. Forget what you think you know about buying a house. Most of us are taught there's only one way to do it. Crawl to a bank and beg for a mortgage. But that path is a maze of endless paperwork, invasive credit checks, and decades of debt. A system built to benefit the banks, not you. They want you boxed in, relying on their approval, their rules, and their schedule. But what if that whole system was just optional? What if there were insider strategies that savvy buyers use every single day to sidestep the banks completely? These aren't sketchy loopholes, they're proven, legitimate methods that put the power back in your hands. Stay with me, and I'll show you exactly how it's done. We're breaking down 4 of the most powerful ways to buy property without ever asking a banker for permission. By the end of this, you won't just be informed, you'll be armed with the knowledge to take control of your own real estate destiny. ******. Credibility, ****. Look, I've been a real estate investor for over a decade, and the most successful people I know? They almost never use traditional banks. They're playing on a completely different field using something called creative financing. This isn't just theory. These are legal, documented strategies that title companies and attorneys handle every day. The game is tilted in favor of the big financial institutions, but only if you play by their rules. Today, we're flipping the board over. We're going to talk about the strategies that give you the speed, flexibility, and access to deals you never thought were possible. Let's jump in with a classic. Section 1. The ultimate, be the bank, strategy. Seller financing. The first, and maybe the cleanest, way to buy property without a bank is called seller financing. The idea is refreshingly simple. Instead of getting a loan from a bank, the seller becomes your bank. You give them a down payment, and then you make monthly payments directly to them, at an interest rate you both agree on. So, how does that work? Imagine you find a great property, and the owner, let's call her Carol, owns it free and clear, no mortgage. Instead of you going to a big national bank, you go to the Bank of Carol. You and Carol, usually with attorneys or realtors to make it official, agree on the price, down payment, interest rate, and a payment timeline. It's all locked into a legal document called a promissory note, which spells out all the terms. But why would a seller ever do this? That's the first question everyone asks. The answer is simple. It's a huge win for them, too. First, they can often command a higher price because they're offering the convenience of financing. Second, instead of getting a giant lump sum of cash that gets hammered by taxes, they create a steady, passive income stream for themselves. Their property transforms from a static asset into a cash-flowing machine. And third, it opens their door to a much bigger pool of buyers, people just like you, who are ready to buy but want to skip the traditional hassle. What does this look like in the real world? Let's say you find a house listed for $400,000. The seller owns it outright. You could offer them $40,000 down, 10%, and they finance the other $360,000 at a 6% interest rate over 30 years. Just like that, you're in the house with a solid down payment and zero bank interrogation. The seller gets $40,000 cash in their pocket right away, plus a check for about $2,158 every month for the next 30 years. It's a true win-win that cuts the middleman right out of the picture. Section 2. The takeover method. Buying, subject to, this next strategy is a little more advanced, but man, is it a powerful tool. It's called buying a property, subject to, the existing mortgage. It means exactly what it sounds like. You take ownership of the property, but the original mortgage stays in the seller's name. You just take over the payments. Hold on, is that allowed? Yes, the transaction itself is 100% legal, but here's where it gets interesting. Most mortgages have a due on sale clause. Technically, this gives the lender the right to demand the full loan balance if the property is sold. It's the bank's safety net. However, it's a calculated risk because banks are in the business of collecting interest, not owning houses. As long as the payments keep coming in on time, they often don't enforce the clause. Why would they trade a perfectly performing loan for an expensive, time-consuming foreclosure? It's not a guarantee, but for many investors, it's a risk worth taking. So why on earth would you do this? The biggest reason? To lock in an incredible interest rate from the past. Imagine a seller who got a 2.75% interest rate back in 2021. With today's rates so much higher, taking over their loan is like finding a golden ticket. Your monthly payment will be dramatically lower than it would be with a new loan. That difference can turn a property that loses money every month into one that's profitable from day one. Plus, you can often get into these properties with very little cash. If a house is worth $350,000 and the seller still owes $320,000, you might only need to pay them the $30,000 difference to take over the property, and their amazing low payment. This is a lifesaver for motivated sellers who need to move fast or don't have enough equity to cover realtor fees. You solve their problem, and you get a property with fantastic financing already built in. Section 3. From renter to owner, the lease option, rent to own, for a lot of people, the two biggest mountains to climb are the down payment and the credit score. The lease option, or what most people call rent to own, is designed to help you conquer both. How's it structured? A rent-to-own deal is a brilliant mix of a rental lease and a purchase contract. It gives you the option to buy the property at a pre-agreed price after a set period, usually 1 to 3 years, but you're not forced to. Here's the breakdown. 1. The option fee. You pay the seller an upfront, non-refundable, option fee, usually around 15% of the future purchase price. This money buys you the exclusive right to purchase the home later and usually gets credited toward your down payment. 2. Locked-in price. You and the seller agree on the purchase price today. This is a massive advantage. If the home's value shoots up over the next few years, you still get to buy it at today's locked-in price. 3. Rent credits. Each month, a portion of your rent payment gets set aside as a credit toward the purchase price or down payment. Who's the perfect person for this? This is tailor-made for someone with a good income who just needs a little time to get their financial ducks in a row. It lets you live in your future home while you work on boosting your credit or saving more cash. You get to test drive the house, the neighborhood, everything, before you commit. And if you decide not to buy, you can walk away, though you'll lose your option fee and credits. It's a clear, structured ramp to homeownership for anyone feeling locked out of the game. Section 4. The ultimate financial cheat code. House hacking. Our final strategy isn't about avoiding a loan entirely, but it's a way to have someone else pay your loan for you. It's how you can live for free and sidestep the financial burden of a mortgage. This is house hacking. What exactly is house hacking? The concept is beautifully simple. You buy a small multi-unit property, like a duplex, triplex, or fourplex, live in one unit, and rent out the others. The rent you collect from your tenants covers most, or maybe even all, of your monthly mortgage payment. How is this a cheat code? While you still get a loan, you use a special government-backed loan, like an FHA loan, that feels like a loophole. FHA loans are for people who will live in the property, and they let you buy a building with up to 4 units for as little as 3.5% down. If you tried to buy that same building as a pure investment, a bank would demand 20-25% down. This is how you bypass their strict investor rules. Let's run the numbers. Say you buy a fourplex for $500,000 with an FHA loan. Your down payment is just $17,500. Your total mortgage payment might be around $4,000 a month. But you live in one unit and rent the other three out for $1,500 each. That's $4,500 in rental income. Think about that. Your tenants aren't just paying your entire mortgage, they're handing you $500 in positive cash flow every month. You are living for free and getting paid for it. After a year, you can move out, rent out your unit, and do it all over again. This is the single fastest way to build a real estate portfolio and achieve financial freedom, all by using the system in a way most people don't even know is possible. #*****, conclusion and CTA, ***, so that's it. Seller financing, subject to deals, lease options, and house hacking. 4 powerful strategies to buy property without begging the big banks for permission. The road to owning a home or building an investment portfolio is so much wider than they want you to believe. Real freedom comes from knowing these options are out there. And these are just the beginning. New models like co-buying and fractional ownership are making it even more accessible. If this opened your eyes, do me a favor and hit that like button and subscribe for more secrets from the world of real estate investing. Now I want to hear from you. Drop a comment below and tell me which of these strategies you're most excited about. Until next time, stop playing their game. Start building your own.